So the first model we want to look at is modern portfolio theory, or MPT, which was which introduced many of the asset pricing theories and models that we still use today. The key models that emerged from MPT include the capital asset pricing model, CAPM, the arbitrage pricing theory, APT, and the Fama-French three-factor model. Each of these models represents an evolution in our understanding of how assets should be priced and what factors determine expected return. Capital asset pricing model was the first major breakthrough, providing a simple but powerful framework for understanding the relationship between risk and return. APT extended this framework to include multiple risk factors. The Fama-French model added additional factors that empirical research showed were important for explaining asset returns. These models don't just have academic interest. They're used extensively in practice for portfolio management, performance evaluation, cost of capital calculations, and risk management. Understanding these models is essential for anyone working in finance or investment management. The capital asset pricing model, CAPM, is perhaps the most important single equation in modern finance. The CAPM formula is based on a single factor, beta, that represents systematic risk. The model is expressed as RI, which is the return on an investment, is equal to RF, which is the risk-free rate of return, plus beta I times RM, which is market return, minus RF, minus the risk-free return, plus epsilon sub I. So let's break it down and see what each component represents. RI represents the expected return on an asset. RM is the expected return on the market portfolio, which is typically the S&P 500. RF is the risk-free rate, which is the interest rate you can earn by leaving your money in the bank. And the beta factor measures the sensitivity of asset I's return to changes in the market return. The epsilon I term represents random error. The beauty of capital asset pricing model lies in its simplicity and intuitive appeal. It says that the expected return on any asset should equal the risk-free rate plus risk premium. The risk premium is determined by multiplying the market risk premium, which is RM minus RF, by the asset's beta. This makes intuitive sense. Investors should be compensated for taking on risk, and the amount of compensation should be proportional to the amount of systematic risk they're taking on. Assets with higher betas should have higher expected returns to compensate investors for the additional risk they're taking. CAPM provides a benchmark for evaluating whether assets are fairly priced and helps investors understand what return they should expect for taking on particular levels of market risk. The arbitrage pricing theory, APT, represents an important extension and alternative to CAPM. APT is an alternative theory that extends beyond CAPM by supporting multiple factors to estimate systematic asset risks. While CAPM assumes that only market risk matters, APT recognizes that multiple economic factors can systematically affect asset returns. APT is based on the premise that several factors can cause expected rates of return on assets to diverge systematically from their expected values. These factors might include changes in inflation, industrial production, interest rates, credit spreads, or other macroeconomic variables. The key insight of APT is that asset returns are driven by multiple systematic risk factors, not just overall market movements. This is more realistic than CAPM single factor approach because economic reality involves multiple sources of systematic risk. For example, a utility stock might be particularly sensitive to interest rate changes, while a technology stock might be more sensitive to economic growth rates. APT allows us to model these different sensitivities explicitly rather than assuming all systematic risk just comes from general market movement. The mathematical formulation of APT shows its multi-factor approach. The expected rate of return on an asset is expressed as a linear function of multiple factors, such as macroeconomic factors, including inflation, gross domestic product, interest rates, which capture different aspects of systematic risk in a portfolio or asset. So you can see the formula here, R sub J, which is the return on the expected return on asset J, is again equal to the risk-free rate RF plus beta n, which represents the sensitivity of the asset price to factor n, and lambda n, which represents the risk premium linked with factor n. This framework is much more flexible than CAPM because it can accommodate any number of risk factors that are relevant for a particular asset or market. For example, we might include factors for interest rate risk, economic growth risk, and industry-specific risks. The predicted advantage is that APT can provide more accurate risk and return estimates by explicitly modeling the multiple sources of systematic risk that affect asset prices. However, this comes at the cost of increased complexity. We need to identify the relevant factors and estimate the sensitivity to each factor. Finally, the Fama-French three-factor model. The Fama-French three-factor model represents one of the most successful empirical extensions to CAPM. This model is an extension to CAPM that attempts to identify specific factors that help estimate returns on assets more accurately than CAPM alone. The model adds two additional factors to the basic CAPM framework: the size factor and the value factor. The mathematical expression is expected return on asset I minus the risk-free rate is equal to beta I times E of the market return minus the risk-free rate plus beta I times E of SMB, and we'll explain what that is, plus beta I times E of HML. So RF again is the risk-free rate of return. RM is the expected return on the market portfolio. SMB is small minus big. That's what it stands for. It represents the difference between the expected return on a portfolio of small stocks and a portfolio of big stocks. And HML is high minus low, which represents the difference between the expected return on a portfolio of high book-to-market value and a portfolio of low book-to-market value. The empirical evidence shows that small cap stocks tend to outperform large cap stocks over long periods, and value stocks, which are high book-to-market value, tend to outperform growth stocks, which are low book-to-market value. The Fama-French model captures these systematic patterns that the CAPM alone cannot explain. This model has been extremely important in both academic research and practical portfolio management, leading to the development of factor-based investment strategies.